Today, we'd like to explain what a recession is, how common they are, and why it is important to remember that not every recession leads to a crisis. Hi, I'm Tim Rocks, Chief Investment Officer at Evans & Partners. The word recession is an emotive one. It can create fear amongst investors because many will associate the term with very bad outcomes like the GFC. However, recessions can also be relatively mild. So when thinking about your portfolio over the next year, the most important question might not be, will we have a recession, but rather, will we have a severe recession? A normal recession may not be as bad as you fear. What constitutes a recession is a blurry concept. Generally, 2 straight quarters of real GDP contracting meets the classic technical definition. This is what is normally found in textbooks and quoted by the media. But these contractions could be very modest, say only 0.1% of GDP, or could be purely driven by volatile external forces such as inventories or trade, with the labour market, that is crucial, not showing any strains. Neither of these would feel like a recession or really have permanent impacts on markets. In the US, the National Bureau of Economic Research tries to be a bit more accurate. It defines a recession as a significant decline in activity spread across the economy. Arguably, this is a better way of doing things as it considers a wide range of factors, especially with regards to the labour market. True recessions that feel like recessions are periods when there is a sustained period of subdued or negative GDP, and this leads to job losses, a jump up in the unemployment rate, increased bankruptcies, and weaker corporate profits. Mention the word recession and memories of COVID or the GFC are stirred up, as this was the last lived experience. This is human behaviour, but what is quickly forgotten is that these were not typical. Unlike Australia, US business cycles are shorter and recessions occur regularly. Since World War II, the US has averaged a recession every 5 years, and old-fashioned ones, triggered by the Federal Reserve tightening too much because the economy was overheating, have been common but also far less destructive. Of the 12 business cycles since World War II, 8 were ended by Fed over-tightening. Recessions are clearly painful for those directly impacted, but it must be remembered that not every recession leads to a crisis, and context is particularly important. The GFC was an implosion of the housing market and banking system, and households undertook significant deleveraging. The tech bubble, after 2000, was more isolated, but it had larger earnings and wealth effects. The COVID recession was engineered by government-mandated lockdowns, but had a significant and fast policy response. Relative to how things were placed ahead of previous US recessions, the underlying fundamentals now look better, and systematic stress points are less obvious. US consumer and business balance sheets are in solid shape. A large stock of excess savings has been accumulated. Private sector leverage is lower. Lending standards have never been higher. Banks are well capitalised. And the starting point for the labour market is historically strong. Although we think the US will experience a recession on the back of an extended period of restrictive Fed policy settings, we believe the odds of a deep recession due to a crisis are low. However, we do think that even though the recession will be shallow, it could take some time to unfold. This is because it takes time for rising interest rates to work their way through the economy. The Fed may also have to maintain high rates for longer, for some time, to reduce wage pressure in the labour market. Tackling inflation, which has become much more than a supply chain goods issue, remains the US Fed's focus. From a risk management perspective, central banks understand that the long-term benefits of bringing down inflation outweigh the short-term hit to growth. This is the price that needs to be paid to tame inflation. The bottom line is that we think that this could be a long but shallow recession. We are not expecting a permanent impact on equity markets from this, but volatility could continue for some time. Investors should be on the lookout for opportunities created by this volatility, and we will continue to recommend opportunities as we identify them. To find out more, please contact your advisor.